A real estate investor buys an apartment building for $1 million. 10 years later, sells it for $5 million. $4 million in gains at 23.8% capital gains tax. That's $952,000 owed to the IRS, except he doesn't pay not a dollar. Not through fraud, not through offshore accounts, through a provision in the tax code. Section 1031, the like-kind exchange. He takes the $5 million from the sale, immediately buys another property, a bigger building worth $6 million, uses a $5 million as down payment, gets a loan for the rest, and the capital gains tax deferred indefinitely, not eliminated, deferred. But here's where it gets extraordinary. He holds that property for another decade, sells for $12 million, $7 million in gains from the original, plus another $6 million from this property, $30 million total gains accumulated as he pay tax. No, another 1031 exchange. Buys a $20 million property, defers again. This continues for 40 years. Property after property, exchange after exchange. He builds a $1 billion real estate empire, never paying capital gains, not once. And when he dies, the stepped-up basis provision erases all gains. His heirs inherit at current market value $1 billion. Zero tax ever paid on decades of appreciation. This isn't theory. This is how every major real estate fortune in America was built. The Trumps, the Kushners, the Zells. Sam Zell did over 100 exchanges, built a $20 billion empire, paid almost no capital gains tax ever. And it's completely legal, written into Section 1031 of the Internal Revenue Code. Since 1921, 103 years of tax-free real estate wealth accumulation. For those who know, for those who use it, for those who understand that the system isn't designed to be fair. It's designed to reward asset ownership over labor, over savings, over everything else. The history reveals the intent. In 1921, Congress passed the Revenue Act, post-World War I. The economy was adjusting. Farmers were struggling, had to sell land in one state, buy land in another. Each sale triggered capital gains tax, depleted their working capital, made moving impossible. So Congress created an exception if you sell property and immediately buy similar property, like-kind property. The gain isn't recognized, isn't taxed, because you haven't really cashed out, haven't really profited, just moved from one asset to another. The logic was sound. The farmer sells land in Iowa, buys land in Nebraska, same use, same investment, no real gain realized, so no tax. This made sense for agriculture, for business equipment, for working assets that needed replacement. But the language was broad. Like-kind meant any property held for business or investment could be exchanged for any other property held for business or investment. Didn't have to, ponto, to be similar. It didn't have to be equivalent. Just had to be investment property. An apartment building for a shopping mall, a warehouse for farmland, an office building for raw land, all qualified as long as both properties were held for investment or business use, not personal residencies, not vacation homes. But anything income dash producing ... qualified, and there was no limit, no cap, no maximum. You could exchange $1 million property or $1 billion property, didn't matter. The deferral applied and could be repeated forever as many times as you wanted, creating an infinite chain of tax-free appreciation. Until death, the mechanics are specific but simple. You identify the property you want to sell, the relinquished property. You list it, find a buyer, but you don't just close the sale. Instead, you use a qualified intermediary, a third party. The buyer pays the key, not you. The QI holds the funds. You have 45 days to identify replacement property, up to 3 properties or more under certain rules. Then 180 days to close, to complete the exchange. The key uses the funds from the sale to buy the replacement property, transfers title to you. You never touch the money, never have constructive receipt. That's critical. If you touch the funds, the exchange fails, the gain is taxable, So the QI is essential, holds the money, completes the exchange, documents everything. And the IRS treats it as a continuation, not a sale and purchase, but a swap, a like-kind exchange. The basis from the old property carries over to the new property. So if you bought the first property for $1 million, sold for $5 million, $4 million in deferred gain, your basis in the new property isn't the $5 million you used. It's your original $1 million basis, plus any additional cash you invested. So if the new property costs $6 million, you used $5 million from the exchange, plus $1 million new money, your basis is $2 million, not $6 million. The $4 million gain is embedded deferred, waiting until you eventually sell without exchanging, or until you die. And the stepped up basis erases it. If you're beginning to see how the ultra wealthy use this to build dynasties, how real estate billionaires never pay capital gains on decades of appreciation, how this legal provision has created more tax-free wealth than almost any other, then you need to understand exactly how to use it yourself. Subscribe now, because what comes next is the step-by-step process. The exact rules, the documentation, the strategies, the ways to maximize it, to chain it, to combine it with other tax provisions, to build wealth the way they do, legally, systematically, strategically. This isn't just for billionaires. It's for anyone who owns investment property, anyone willing to exchange instead of sell, anyone who wants to defer taxes. Indefinitely, the knowledge is power. The application is wealth, and you're about to learn both. Zell is the perfect case study. Built equity office properties. At its peak, worth $39 billion, the largest office landlord in America. And he used 1031 exchanges constantly. Described it in interviews. In his book, as a secret to real estate wealth, he'd buy a property, hold for a few years, sell at a profit, exchange into a larger property. Repeat. Each cycle, his portfolio grew, his equity increased, but his tax bill, minimal, because the gains were always deferred, never realized, never taxed. He did this for 50 years, from the 1970s until he sold equity office in 2007 for $39 billion. That final sale was taxable, but by then, he'd accumulated so much wealth through decades of tax-free compound that paying tax on the final sale was irrelevant. He'd already won, had already built the empire, using deferred taxes as permanent leverage, as interest-free loans from the government that he only repaid at the end, if ever. Because if he'd held until death, the stepped-up basis would have erased even that final tax. His heirs would have inherited at market value, billions, with zero capital gains tax, ever, on 50 years of appreciation. This is the power of 1031 combined with stepped-up basis. It's the wealth creation machine, hidden in the tax code, used by every real estate billionaire, but available to anyone who knows it exists. The Trump family fortune was built on this. Fred Trump bought properties in Brooklyn, Queens in the 1940s and 50s, exchanged into larger properties, deferred gains. His son Donald inherited this strategy, used it extensively. The New York Times obtained his tax returns, showed he used 1031 exchanges repeatedly to defer millions in gains, to build his property empire without paying capital gains. When he sold properties, he'd exchange into others, chain them together. Defer indefinitely. This isn't criticism. It's documentation of how real estate wealth works. In America, under current law, the strategy is simple. Buy a property with leverage, hold while it appreciates, depreciate it for tax deductions, reducing ordinary income tax. Then when you sell, don't pay capital gains. Exchange into a bigger property. Repeat. Each cycle you control more real estate, generate more income, build more wealth, and the tax bill always deferred. Always tomorrow, never today. It's the ultimate leverage. The government becomes your silent partner, allowing you to use tax money that would have been paid as additional investment capital, growing your empire forever. But here's what makes it truly powerful. The combination with depreciation. Real estate can be depreciated. 27.5 years for residential, 39 years for commercial. Even though the property is actually appreciating, gaining value, you take paper losses. deductions against your taxable income, reducing ordinary income tax, then when you sell ... the depreciation is recaptured, taxed at 25% plus capital gains on the appreciation, except with a 1031 exchange. You defer both. The depreciation recapture and the capital gains. And you start depreciating the new property from a higher basis, creating more deductions. So you're reducing ordinary income tax through depreciation, while deferring capital gains and recap through 1031 exchanges. It's a double benefit used simultaneously to minimize taxes, maximize wealth, and compound returns without tax drag. This is why real estate creates more millionaires than any other investment. Not because real estate appreciates faster, but because the tax benefits multiply the returns, make the effective rate of return after taxes higher than any other asset class. Do you see why the wealthy don't invest like you do? Why they don't buy index funds in taxable accounts? Why they focus on real estate and operating businesses? Because those assets have tax benefits that make the after-tax returns dramatically higher. A stock portfolio might return 8% annually, but you pay taxes on dividends, on capital gains when you sell. Your after-tax return might be 5%. A real estate portfolio might return 8% annually, but you deduct depreciation, reducing your taxable income, deferring capital gains through your after-tax return might be 10% or higher because you're keeping money that would have gone to taxes and reinvesting it, compounding it, building wealth. That's the secret. It's not what you make, it's what you keep after taxes. And the tax code is written to let you keep more if you use the right structures, the right strategies, the right provisions, like Section 1031. The reform attempts reveal who has power in 2017. The Tax Cuts and Jobs Act eliminated 1031 exchanges for personal property, for equipment, for vehicles, for everything except real estate. Why? Because real estate has the most powerful lobby in Washington, the National Association of Realtors. One of the largest PACs donates millions to both parties. The home builders, the developers, the commercial property owners, they fought hard, kept 1031 for real estate. While eliminating it for everything else, this tells you who writes the laws, who benefits, who the system protects. Not farmers anymore. Not small businesses exchanging equipment, but real estate investors, developers, landlords, the people who own the physical assets that generate wealth through leverage, through appreciation, through rent, and through tax deferral. The system is designed for asset owners. If you're an employee, trading your time for money, paying ordinary income tax, you're playing the wrong game. The game is asset ownership with tax benefits that multiply returns. And 1031 is the biggest benefit in the entire code for real estate. The qualified intermediary industry is worth understanding because it shows scale. There are thousands of QI companies facilitating billions in exchanges annually. The largest ones handle hundreds of millions in transactions. Each year, they're regulated, bonded, licensed, but essentially they're holding companies for your money during the exchange period. And there are risks. If the QI goes bankrupt, your funds might be lost. It's happened. Rare, but possible. So choosing a reputable key with insurance, with track record is critical. But the existence of this entire industry shows how common 1031 exchanges are. How embedded in real estate investing, every professional investor knows about it, uses it, plans for it, but most individual investors don't even know it exists, don't use it, pay full capital gains when they didn't have to, because nobody told them, because the system is complex, deliberately complex to separate the informed from the uninformed, and the informed build wealth through tax efficiency, through legal strategies that the uniformed never discover. If this is revealed that there's a way to never pay capital gains on real estate, that you can exchange properties indefinitely, that billionaires have used this for a century to build dynasties, that it's completely legal and available to you, then you need to understand what happens next. Subscribe now, because the next investigation shows the loopholes within loopholes. The reverse exchanges, the improvement exchanges, the Delaware statutory trusts, the ways to structure even more creatively, to defer even longer, to build even faster. The tax code is a treasure map for those who can read it, for those willing to use it, for those who understand that wealth isn't built through working harder. It's built through tax efficiency, through leverage, through strategies that most people never learn, but that you're learning now, right now, in this moment. The question is, what will you do with this knowledge? The improvements exchange is particularly clever. You sell a property, have excess cash from the sale, want to exchange. But the replacement property costs less than the proceeds. Normally, this creates taxable boot. The leftover cash is taxable gain, but with an improvement exchange. The QI holds the funds, uses them to improve the replacement property, renovation, addition, upgrades within the 180-day window. The improvements add value, increase the cost basis, and absorb the excess cash, making the exchange tax-free. This strategy requires careful timing, pre-planning, but it works. Allows you to exchange into a property that needs work, fix it up with the exchange proceeds, and defer all the gains while adding value through forced depreciation. It's sophisticated, used by experienced investors, but available to anyone who understands the rules and executes properly. The reverse exchange is even more powerful. Normally you sell first, then buy replacement. But what if you find the perfect replacement property? Before you've sold your current property, you can't wait. Someone else will buy it. So you do a reverse exchange. The QI buys the replacement property, holds it while you sell your current property, then transfers the replacement to you, completing the exchange. This is more complex, more expensive, but it works. Allows you to control the timing to secure the property you want, then sell your property without time pressure. The QI becomes the parking entity, holding one property temporarily while the exchange completes. It's a sophisticated tool, but it solves real problems and keeps the 1031 benefits intact. The Delaware Statutory Trust deserves special mention. It's a structure that changed 1031 exchanges. Before DSTs, you had to identify actual properties, specific buildings, specific land, and if the deal fell through, if the seller backed out, you failed the exchange, paid taxes. The DST solves this. It's a prepackaged investment, usually institutional grade real estate, apartments, shopping centers, medical buildings, already owned, already operating. You can identify ADST as your replacement property. Closing days, no risk of the deal falling apart because the property is already purchased, already stabilized. You buy a beneficial interest in the trust that owns the property. The IRS treats it as direct property ownership for 1031 purposes. So it qualifies for the exchange, and you get institutional quality, professional management, diversification, without the headaches of direct ownership. This opened 1031 exchanges to smaller investors, to those who can't manage large properties, to those who want passive income with tax deferral. It democratized the strategy, made it accessible, and grew the market significantly. Wake up. Section 1031 has been in the tax code for 103 years, creating tax-free wealth for real estate investors, while everyone else pays capital gains on every sale. The difference is knowledge, is structure, is using what's available legally, strategically, intentionally. Every real estate billionaire in America used 1031 exchanges to build their empire. Sam Zell, Donald Trump, the Kushners, the Helmsleys, all of them exchanged properties deferred gains, compounded wealth without tax drag for decades. And when they died, the stepped up basis erased the deferred gains completely. Their heirs inherited tax-free billions built on deferred taxes that were never paid. This is the system. This is how it works. Not through corruption, through code written clearly, available openly to anyone who learns it. The question you have to ask yourself is simple. Will you keep investing like an employee, paying full freight on every transaction? Or will you start investing like the wealthy do, using every legal advantage, deferring every deferrable gain, building wealth through tax efficiency, through 1031 exchanges, through knowledge? That separates the wealthy from everyone else. The choice is yours. The system is waiting. The properties are there. The queue is already. The only missing piece is your decision to act, to exchange, to never pay capital gains. Again, the code allows it. The wealthy use it. And now,